As a Japanese housewife living in the US, I want to look at the counterfacts of socialization from unique perspectives.
Have you ever heard the term de-risking in banking and wondered what it really means? It sounds like something banks do to protect themselves, right? Well, yes, but the story is much more complex, and it affects millions of people around the globe, often in ways you wouldn't expect. Today we're diving deep into the world of anti-money laundering, or AML, and the controversial practice of We'll separate the facts from the fiction and uncover the real-world consequences of this global trend. So, let's start with the basics. What is money laundering? Simply put, it's the process of making illegally gained money or dirty money appear to come from a legitimate source. Criminals do this to hide their activities like drug trafficking, terrorism, financing, or to combat these. Governments and international bodies have created strict AML regulations that banks and other financial institutions must follow. They're required to know their customers, monitor transactions, and report any suspicious activity to the authorities. The penalties for non-compliance are a huge. We're talking billions of dollars in fines and severe reputational damage. This is where de-risking comes in. Faced with these immense pressures, some banks have decided that certain customers, or even entire categories of customers, are just too risky to deal with. Instead of managing the risk, they choose to eliminate it altogether. How? By closing accounts, refusing to open new ones, or cutting off relationships with other banks in certain regions. This is what we call On the surface, it sounds like a logical business decision. Why take the risk if you don't have to? But the reality is far from simple. One of the biggest myths about de-risking is that it's a precise surgical tool used only to cut out confirmed criminals. The truth is, it's often a blunt instrument. Banks might decide that an entire country is high risk, or that a whole industry, like charities or money transfer businesses, is too difficult to monitor. As a result, they terminate relationships with all clients in that category, regardless of whether they're legitimate or not. This is often called wholesale de-risking, and it has devastating consequences. Imagine you're a small charity working in a developing country, providing essential food and medical supplies. Suddenly, your international bank account is closed. Why? Because the bank has decided your region is too high risk for its comfort. Now, you can't receive donations from overseas. You can't pay your local staff, and your life-saving work grinds to a halt. This isn't a hypothetical scenario. It's happening to non-profits all over the world. They are being cut off from the global financial system, not because they did anything wrong, but because of a bank's blanket risk assessment. Another group hit hard by de-risking are remittance companies, also known as money service businesses. These are the companies that millions of migrant workers use to send money back home to their families. For many families in developing nations, these remittances are a lifeline. They pay for food, education, and health care. But because these businesses handle large volumes of small cash transactions, some banks see them as a high risk for money laundering. When, among the risks, a remittance company It can disrupt the flow of money to entire communities, pushing people towards unregulated and often more dangerous channels to send and receive funds. This brings us to a crucial point. De-risking doesn't actually stop money laundering. In fact, it can make the problem worse. When legitimate people and businesses are pushed out of the formal banking system, they don't just disappear. They turn to informal or underground financial networks. These networks are completely unregulated and opaque. There are no transaction records, no customer due diligence, and no suspicious activity reports. This makes it far easier for actual criminals to hide their activities. So, in an attempt to reduce risk, de-risking can inadvertently drive financial activity into the shadows, making it harder for law enforcement to track the very criminals they're trying to catch. It's a classic case of the solution creating a bigger problem. So why do banks continue to de-risk if it's so counterproductive? The answer lies in the balance of risk and reward. The cost of complying with AML regulations is incredibly high. Banks have to invest in sophisticated software, hire large compliance teams, and constantly train their staff. A single mistake can lead to a multi-billion-dollar fine. For a bank, the profit they might make from a small charity or a remittance company in a high-risk country might seem insignificant compared to the potential penalty if something goes wrong. It becomes a simple, cold calculation. The perceived risk outweighs the potential profit. So, they cut ties. This creates a serious issue of financial exclusion. Access to basic banking services is essential for participating in the modern economy. Without a bank account, it's difficult to run a business, receive a salary, save for the future, or build credit. De-risking disproportionately affects the most vulnerable populations in the world: people in developing countries, refugees, migrant workers, and small non-profits. It widens the gap between the banked and the unbanked, hindering economic development and perpetuating poverty. The very people who need access to the financial system the most are the ones being locked out. International bodies like the World Bank and the Financial Action Task Force, or FATF, which sets global AML standards, have recognized this problem. They've clarified that their rules do not require wholesale. They advocate for a risk-based approach, which means banks should assess the specific risk of each individual client rather than rejecting entire categories. The idea is to manage risk, not avoid it entirely. But changing the behavior of massive risk-averse institutions is a slow and difficult process. So, what's the path forward? The solution isn't to get rid of AML regulations. They are a crucial tool in the fight against crime and terrorism. Instead, we need a smarter, more balanced approach. First, regulators need to provide clearer guidance and perhaps create safe harbors for banks that serve certain types of clients in good faith, protecting them from massive fines if they've made a reasonable effort to comply. This would reduce the fear factor that drives wholesale debt. Second, technology can play a huge role. New innovations in fintech and regtech, that is, financial technology and regulatory technology, are making it easier and cheaper for banks to conduct due diligence and monitor transactions effectively. Digital identities, artificial intelligence, and blockchain can help automate compliance processes, reducing costs and improving accuracy. By embracing these technologies, banks can manage risk more effectively without having to resort to cutting off entire customer segments. Third, we need greater collaboration. Banks, governments, and nonprofits need to work together to find solutions. Sharing information about risks and best practices can help build a more resilient and inclusive financial system. For example, banks could collaborate to create shared platforms for customer due diligence, reducing the burden on individual institutions. Finally, as consumers and citizens, we can raise our voices. By understanding the issue of de-risking and its real-world impact, we can support policies that promote financial inclusion. We can encourage our banks to adopt a more nuanced, risk-based approach rather than a one-size-fits-all policy of exclusion. The narrative that de-risking is a necessary evil to keep the financial system safe is a dangerous oversimplification. The reality is that it's a flawed strategy that hurts the innocent, undermines economic development, and can even make it harder to catch the bad guys. By pushing for a smarter, more inclusive approach, we can build a financial system that is both safe and accessible to everyone, everywhere. The goal should not be to eliminate risk, because that's impossible. The goal should be to manage it intelligently. Thank you so much for joining me on this deep dive into AM. It's a complex topic, but an incredibly important one. If you found this video helpful, please give it a thumbs up and consider subscribing for more content that breaks down the big issues shaping our world. And I'd love to hear your thoughts in the comments below. Have you or your business been affected by de-risking? Let's get the conversation started. Thanks for watching, and I'll see you in the next one.